Hi, everyone. Welcome to another episode of Good Investing. I'm your host, Tim Nash. As people start looking more closely at their investments, the most common questions I get are about switching advisors. It can feel awkward and intimidating and even scary. Well, it's not that hard. Today, I'm joined by Darryl Brown, Portfolio Manager and Head of Eastern Canada at Genus Capital Management. Darryl and I have a quick chat about tariffs and what investors can do amidst all of this uncertainty before diving into the main topic, how to switch investment advisors. Let's go. How to switch investment advisors. We've got a really good webinar for you tonight. Really pumped. First of all, welcome. Thank you so much, everyone, for joining. It means the world to Darryl and to myself that you joined, that you're kind of choosing to spend your Tuesday evening. If you're in Ontario on the East Coast, your Tuesday afternoon, you're sort of just pre-happy hour. And if you're in Alberta, then you're spending your happy hour with us, which really grateful. Welcome. I am coming here from Toronto. Darryl, I think you as well. This is Treaty 13 territory, home of the dish with one spoon wampum. Would love to know who is in the chat. That if you can let us know where you're from, I would love to see. Sort of just my dream is to have people from sort of coast to coast to coast, but typically we do get a nice sort of wide smattering. So if you can say Jason from Ottawa, and if you don't mind putting it in the chat, would love to hear that. Before we jump into the webinar topic tonight, do just kind of want to acknowledge the elephant in the room. I kind of pulled this image. I think it's there's like a nature photographer that managed to snap this recently, which is sort of the Canadian goose and the American bald eagle getting into a little squabble here. That, we do have this is quite a day for us to be chatting. That obviously we do have scary tariffs that went into play today. So Darryl, if it's cool with you, just want to spend a few minutes kind of chatting about this. Like, how was your day on an intense day like this? I imagine for you, there are a lot of folks kind of with questions or a little bit worried, like, anything you want to share with us to sort of set the table before we do jump into this.
Yeah, happy Tariff Tuesday. So today it wasn't as crazy, quite honestly, as I think people might think. It's something, the tariff and the trade war has been something that I and we at Genus been monitoring for a number of months now. It's something that is not surprising to us in terms of, there actually being tariffs that have been overlaid. And, we're not convinced that this is the end of it. I don't think this is going to be something that is going to, sort of dissipate over time. The administration is quite unique in terms of their stance and their views. So today was not as it wasn't as busy. It was just disseminating information to clients. It was absorbing all the news, seeing the market reaction. And the response for us as an investment firm over the last few months has been to gradually look at our holdings and become a little bit more defensive, just given the uncertainty we're experiencing right now. And then some of the uncertainty we're going to likely experience in 2025. 2025 is not going to be the year 2024 was when it comes to investing.
The one where they treat the employees well, and maybe it's eco-certified kind of thing, but it's still like buying a coffee from a chain, whereas impact investing is really about going to your local coffee shop. If you're someone that's like, screw the American chains, I want to buy from my local coffee shop now, support Canada. The way we support Canada with our investments really are through impact investments. So things like community bonds and things like that. We've got a lot of resources on that we chatted about. When it comes to the doing less evil US stocks, really, my personal opinion is that people should not be completely divesting from US stocks. I'm seeing a lot of posts, I'm getting questions, I'm getting emails from clients that are like, no US stocks, I want to completely divest from the US. I would not suggest doing that. I would stick very much to our doing less evil approach. A lot of people are looking to get rid of things like Tesla is probably the number one company I'm getting emails about. Like, Tim, I don't want Tesla in my portfolio. Well, a lot of the doing less evil US stock funds actually already don't have Tesla. So, for me, I don't want to paint sort of broad brushstrokes. There's still a lot of Americans, like my American friends. I don't hate them. I don't hate the individuals. It's not like the whole country. If we've got some Americans listening in today, like, we don't hate you, as individuals, but we are kind of angry at the administration right now. So, we really do want to get rid of all the, I'm going to call them like anti-woke stocks. And this is sort of like the doing less evil side, where everyone's going to have different US stocks that you do want to get rid of. So maybe look at your US equity holdings, see what companies are in there, see if there are some deal breakers in there for you. That could be, a situation where you want to move a little further down the spectrum in terms of that doing less evil. And then the last thing is really appropriate for the topic that we have tonight about, switching advisors, which is that, like, really, if you're feeling uncertainty, if you're feeling like a pit in your stomach, that could be a sign that you actually don't have a great game plan, that you either don't have a good advisor or you don't know sort of what you've invested in. You don't really know what's in there. That if you do have a good advisor, they should be sort of holding your hand a little bit through this, providing some reassurance, providing some confidence. If you're a DIY investor and you've got a good plan and you understand your plan, that should give you the confidence to sort of ride out the waves a little bit. So if you've got a good plan, stick to that plan. But if you don't have a good plan, or if you're not feeling confident, or you don't know where your money is invested, like, what are the US stocks I have in my portfolio, Tim? That's a great reason why you should be here tonight. We're so grateful for you to be here. Darryl, anything you want to add to this?
Not really, other than just to say, as we're listening to the headlines, as we're hearing pieces of information hit our phone, come up in conversations, this is going to be a really fantastic time for people to really understand how much financial risk and how much they want to take responsibility for their investments and how they're feeling about that. How confident are they feeling relative to where they might like to be? And so a great test for people at the moment, just ensuring
Absolutely.
that from an investing standpoint and a money standpoint, what you're doing is in your comfort zone, and you're not becoming too overwhelmed by all the headlines and all the news.
Yeah, I think that's a really, really good approach there. If people do have more questions about this, because I think that it really is sort of dominating the conversation right now. So, what we want to do is create a little space for that. So for those of you who are in my classroom, we're hosting an AMA next week. So it's going to be Tuesday next week at noon. For those who aren't in my classroom, this is kind of like my online course, and where all my online courses are, but it's more than just courses. It is like a classroom, and I have these monthly AMAs. I know people have questions about this stuff. So if you want to talk more about tariffs, we're going to create a space for that conversation inside of the classroom. So it's it's $10 a month or $100 a year. I've got a little bit of a monetary gate there. If you are an existing client, or you've taken one of my courses in the past, reach out, let us know. We'll get you in there with a free 1-year subscription, just to kind of get you into that classroom and see what we're doing there. But that's really kind of going to be the place where we can have a further conversation about tariffs, because we have an amazing topic tonight. We've got Darryl here, we're gonna go through lots of amazing things about really understanding why people switch advisors. From there, talk a little bit about the barriers to switching, like some of the reasons people kind of talk themselves into not switching. We're going to go through step by step how to switch advisors, and then we've got some hot tips at the end. So if you're thinking about switching advisors, you're thinking about doing that, then really, really pumped for you to do that. We want to help you out as much as we possibly can, which is why we're going to give you some hot tips there. So my name is Tim Nash. I'm on a mission to help 1 million Canadians invest intentionally. I've already helped probably about 10 to 20,000 people take some kind of action with their money. So really, really, excited about that. Darryl, do you want to give yourself a quick little introduction?
My name is Darryl Brown. I'm a portfolio manager for Genus Capital Management. I'm based in Toronto. Genus is based in Vancouver and has been investing in a very sustainable manner, in a way that aligns with our clients' values. They've been doing that for almost 35 years. And so I'm happy to be their first Toronto hire as of 2023, at the end of 2023 when I joined. And my passion, my background is on sustainability. Tim and I had worked together at Good Investing in the past, and yeah, really got to merge my sort of sense of doing more and doing different things with our money that align with how we live our day-to-day lives. So that's a big part of who I am, and I'm really feel really privileged to be able to work with clients who share that view and work with an organization that supports that.
Absolutely. And we'll learn a little bit more about Genus later on, and the awesome work that Darryl's doing. And then before we dig into it, I do have some news for y'all. My wife is pregnant, which is super exciting. So I'm going to be having a baby girl in June. So it's coming up fairly soon. So I'm super excited. Thank you, Hamid. Really appreciate that. Lori, yeah, give me all the congrats. Gave me all of the emojis in the chat. Give me all of the unsolicited parenting advice. I am here for all of that advice. So that'll be happening in June. But this is it's really exciting for me. It's an exciting time, and really happy to kind of have this conversation now and trying to get people set up so that really I've got the next few months to get myself organized and get everyone organized. But then I probably am going to be taking a little bit of time off over the summer to embrace that. So very, very excited to share that news with y'all, that this kind of, all these conversations about the future and legacy and, what is the future we want to create for everyone? It's only gotten that much more important and that much more exciting. So, all right, without further ado, let's jump into it. I'm going to give, I think the way to do this, Darryl, what I'd like to do is if I can just kind of go through my sort of, reasons why people switch advisors and just like a few slides here. And then, would love to hear from you. And then people in the chat, like, let me know if I hit the mark where you're just like, Tim, this is exactly why I want to switch advisors or why I did it. Let me know. If you've got something to contribute, by all means, let us know. I think the first reason people tend to switch advisors that I've seen a lot of is that their existing advisor just isn't that good, that they're kind of giving them a 1-star rating. There are unfortunately a lot of mediocre advisors out there that don't provide a lot of help, don't provide a lot of context. They're more like salespeople where they want to sell you a product and then kind of never chat with you again. So that's one of the biggest reasons I get is just people aren't really like happy with the service they're getting from their advisor. Another reason is that people are entering a new chapter of their life, and that's kind of forcing the issue. It could be like having a kid and like, RESP and thinking about that. It could be entering into retirement. And now all of a sudden you're like, really nervous about what it means to be entering into retirement and starting to draw down from your money. Could be that you sold a house or got an inheritance or like there's a big life event. But oftentimes when we do start this new chapter, that is a time when people are really thinking about switching advisors and finding someone that's right for that next chapter. Management fees, all of these commercials, the Super Bowl commercials, and all this stuff about management fees and understanding that. If there are people in the chat who are have mutual funds, there's a good chance your fees are really high if it's in mutual funds. So that's absolutely a reason why people like to switch advisors. And then the last one, I'm sorry for the image. Maybe I should have done a little trigger warning here, but it is that like a values alignment piece that unfortunately, a lot of people in the financial industry absolutely have a more conservative mindset and politics. And, for those people who want values-based investing and sustainable investing, sometimes it's like you open up the conversation with your advisor about whether it's divestment or whether it's about, for-profit prisons, whether it's about climate change, whatever the issue is. And it's just like, it turns out that, ooh, this person really isn't in alignment with me on the value side. They don't hear me when it comes to my values and sustainability. And so those are, all I think really big reasons why people are switching advisors. Darryl, what did I miss? Is there anything that I missed in terms of why people are switching advisors?
No, I would just in elaborating on what good service is, because a lot of people might not
Sure.
know. They may have even worked with an advisor for many, many years and still like, what is good service? And so I would say just a good barometer to use in figuring that out is understanding, does that person care about what's going on in your life? Because that matters significantly when it comes to how you have your money invested for you. Are they keeping up to date with family changes, job changes, just your overall health and well-being? That's important in establishing a relationship between someone like myself as an advisor and the person or the household. The second part is solutions from an investment standpoint. Do they have a way of investing your money in a manner that aligns with who you are and your personal values and your
Yeah.
personal worldviews, quite honestly. So those are the two big things. Service, just a lot of people don't understand what good, better, best service is. But just someone who is doing more than picking up the phone once a year to ask for your RSP contributions and solutions. Service and solutions are the big ones.
It really is a relationship, so I think it's the same tenets of like being in a good relationship, checking in with you, seeing how you're doing, if there are changes, understanding that is a big value when it comes to this idea of full service. And I think also like helping you prepare for those next chapters, probably not being as like reactive to them, but more kind of like ahead of the curve. If you are planning on buying a house, we might need to de-risk some of your money, kind of like getting ahead of some of these issues. Chat, what am I missing? Are there any other reasons why people are switching advisors, why you're thinking about switching advisors? This is it. Alice says, uh-oh, I never hear from them. So yeah, so, this is like, maybe we can be doing a little bit better, but really curious about any experiences. I've had so many experiences from folks who have asked their advisor about sustainable investment options. And I think to your point, Darryl, part of it is the values alignment, and then part of it is even just like having the products available, having those sort of doing less evil, doing more good options. Sweet. So maybe we can kind of do the same little exercise here where let me go through sort of these common fears that people have. And then Darryl, I'll kind of get you to comment if there are any that you think, or, chat, if I'm missing anything, like let me know. These are, I think, some of the fears and some of the barriers for why people don't switch. The first thing is just like not knowing where to start, like being full of questions, being full of uncertainty, just like not even knowing what questions to ask when it comes to this conversation. I do feel like that's, for a lot of people, probably the biggest barrier is they've never even thought of it, or they wouldn't even know where to begin. I think part of it, people are worried about like the breaking up with their advisor, that their current advisor is going to try to like talk them out of it, or is going to sort of like guilt them, or like do, have a funny reaction to it. I know it can often, sometimes we have the same advisor as like family members or friends, like if you've got a relationship there, worried about how they're going to handle that, and just feeling bad that, oh no, I might have to like break up with someone. Taxes, that, I think we will cover this a little bit in terms of some of the tax implications, that, sometimes this is a barrier, is worried about, oh no, am I going to trigger capital gains? What are the sort of tax implications of switching? Don't worry, we're going to cover this. It's pretty simple and straightforward. I think one of the biggest fears that I get from people is this notion of like when their money is kind of like in limbo, like moving from one investment firm to another, can be a tricky point. Liz says, I don't know who to switch to. So figuring out your landing point, like that can make the leap even scarier if you, don't know where your landing point is, but, understanding how to properly make that transfer and fill out the forms right, and make sure that your money is right, and that when it is in limbo, like knowing, exactly what to expect every step of the way. All of this can just feel really like overwhelming, and just like, don't even know where to start. Like a lot of people think about this, do it, and they're just like, oh no, like I just don't, they just like can't even, so to speak. And so, really want to remind you that like we are here for you. Darryl, like Liz, if you don't know who to switch to, like I'm so glad you're getting to meet Darryl, that he's created a really, really great landing place for people who who are looking to switch, who want a sustainable option to switch to. But there are, absolutely finding that landing place is critical. And, really just want to be here to make it clear that switching, especially when you've got some help, someone who is on the other side, kind of waiting to receive you, it really takes a lot of the fears and anxieties, and helps to understand what some of those concerns should be before you switch, and make sure that you do have that comfortable landing place, so that when you do make the switch, you know exactly what's happening. Darryl, what have I missed? What's any of these points you want to speak to?
Not a whole lot. It's the overwhelming fear of just not understanding the process, the paperwork that's involved, some of the checks and balances, that whole infrastructure, which you
Yeah.
and I, as big nerds, find really interesting. They all serve to make the moving around of money in our Canadian financial system really as safe as it gets. And so, we
Yeah.
spend a lot of time in that area. We have a client service team that does everything when it comes to transferring clients from one advisor over to us. So we collect a bit of information and then we take it from there. So you don't have to figure this out all on your own. We're going to go through it. And it's great when people understand what's happening, but know that you don't have to do it all on your own.
Yeah, no, you've got help. This is why, we've got professionals. Yeah, Marlene asks, can I switch to Darryl if I live in Montreal, Quebec? But that Marlene, no, unfortunately, Darryl, I think I have this right that residents of Quebec that Genus is not able to serve them. Is that right?
At, at the moment, that's the case. That may change. And if it does, we'll definitely let you know.
And we are kind of looking at other options, and we are hoping that they will change that. I know another barrier in terms of switching, Darryl, that we've often come across is like minimum investment amounts. I think when I started working with Genus and referring, and I feel that it was about a 500K minimum, but we've worked really hard to bring that down. I know it's like definitely as little as 100K. And last time we spoke, you told me that, you've got some wiggle room there, that even clients that are less than 100K, like it's not a big deal. They can still reach out and meet with you. Is that right?
We'll figure it out for clients who are not quite at the 100K mark. There's no fixed amount that I really have when it comes to working with people. So if you are interested in investing in a way that aligns with your values, I feel like the DIY route isn't quite the solution. Reach out. We'll figure it out.
Marlene, I'm working on those options for you, so I don't yet have an update for you. I know we chatted a little while ago, and I am working on those options. But for residents of Quebec, but stay tuned on that. Claire has a great question in regard to fees. What should we look for in an investor as an investor with respect to how they charge? So, I think it is important to understand the different ways that investors or that advisors charge fees, and to give you kind of like a little bit of a benchmark on how it works. The one thing that I can speak to very easily is this idea of like a percentage of your assets versus a flat hourly rate. That when I help DIY investors, I charge a flat hourly rate. So my hourly rate is $750 an hour. I do have discounts, and so for people who can't afford that, I've got 50% discounts, 75% discounts. I even have a number of pro bono hours every month if people do need it. They just might have to wait a couple months until I have some availability there. But that, really for an hourly rate, you're looking at anywhere from like $300 an hour up to $750 an hour. I think I've seen some fee for service folks charge about $1,000 an hour is probably the largest number I've seen. When it comes to percentage fees, Darryl, I see you wrote in the chat like transparency, that's what's really important. Do you want to speak to that?
Yeah, this is something that comes up all the time where, especially when working with advisors, people need to be a little bit clear and a little bit picky about the language when they say fees. There are generally two fees that people are paying when they're working with someone. There's what's called an advisory fee, which is generally think about that as the money that's getting paid to the person to provide advice. There is the product fee or the investment management fee, which relates to the actual management of your product. So product and person are the two separate fees. Sometimes they get wrapped up into one, and people need to be really clear and careful when they're asking either their existing advisor about how much they're paying for fees versus a potentially new destination. And what happens a lot is that if you ask an advisor at, say, Blue Bank or Purple Bank, how much am I paying in fees? They will probably only tell you the advisory fee and completely admit that this set of fees over here, the product fee could be double when you put the two together. So people don't have that transparency and that understanding of, how much is this relationship costing me? And in terms of how much it should cost, that's going to depend on the level of service that person is prepared to provide you or willing to provide you and what you're looking for. So there's quite a range. We at Genus and myself, like we charge management fees for transferring assets in, managing them, looking at people's big picture, RRSP versus TFSAs when people are in retirement. Where do I get my money from? How much? From which accounts? What do I expect from CPP? Like there's all of these different questions. that as a client, we are getting paid to answer for people. But if you're not getting that level of service, then it probably doesn't make sense to pay a significant fee.
Some benchmarks on this just so that people are aware from a percentage standpoint. Like the highest I've seen is like 2.5%, like Investors Group, and some of these, about 2.5%. I've seen some like insurance with like these like insurance salespeople who sell segregated fund, probably at about 3% is like highway robbery. That's probably the highest fee that I've seen. From there, for the cheapest we can do it, if you do sort of DIY, if you do do just ETFs, it can be the absolute cheapest is about 0.25%, 0.25%. And then, where the full service advisors often are kind of in the middle is that they will tack on sort of like a percentage or so. I would say expect to pay in the ballpark of like, 1.7, 1.8% if you're just getting started with a full service advisor. And then from there, know that the fees do go down as a percentage as your assets go up. That this is kind of part of that fee schedule, is that the more money you've got, the lower those fees are going to be. But really what we want to do here is, to Darryl's point, is to get that full picture, the advisory fees plus the product fees. And then from there, just know that I think, Darryl, like it's a pretty stock standard thing. Like if you do meet with folks and you do a free consultation, that you can do a bit of a fee comparison to be able to see sort of like what they're currently paying versus what they would be paying if they switched. Is that
Yeah.
fair?
Yeah, definitely. Those are fun meetings because we get to
Yeah.
dig into things.
Talk about how much money you're going to save with fees.
Yeah.
Because typically what I will say is that most of the time when people are switching, they are shopping around. It is an opportunity to lower your fees. I find that it's often when people have been with the same advisor for a very long time and doing it, and especially if it's someone who, maybe doesn't provide great service, who did sell you a product, that's when we can often do that fee assessment. And it's like, oh my goodness, you're going to save a boatload in fees. Okay, sweet. So then, from there, I think here's where we can kind of spend, I imagine sort of the bulk of the time this is where it's going to be really, really, really useful, is going through step by step how to actually make the switch. So this is where, we do go through and just step by step, really the first step is to decide where you'll land. So I forget who it was in up here that Liz wrote, I don't know who to switch to. So this is like the first step in my mind, is before we actually, do any of the forms or talk about any of the details, is deciding where you're going to land. So this is where, it really does make sense to set up some calls and do some interviews and chat with some folks. So, I've got a link for, folks who do want to set up a free consult with Darryl. I can just kind of throw that in the chat right now. We'll go through it a little bit later, but this is always going to be, for me, is going to be sort of the first step, is setting up free consultations and, chatting with advisors. Darryl, can you like go through what a sort of free consultation, when someone signs up for you and like signs up for a free consult and they're like shopping around for a new advisor, how does that meeting typically go? What does that look like?
It's a lot of digging into what's core and what's important to that person or that family unit. So, who are they? Who's in their household? What's going on? Are people are both people working? Are they in between jobs? Like they've taken time off work, or are they in school? Understanding their picture, understanding what's on the horizon for them. Are they, sort of getting started when it comes to saving for retirement? Are they in retirement? Are they accumulating money for a down payment? So really, we're trying to understand like everything as much as we can about that individual, like that person or that household. And then trying to understand, okay, what gaps are there when it comes to supporting that person and their money journey? Not everybody who I speak to is at the stage where it makes sense for us to start investing their money. They might have financial planning sort of considerations or cash flow considerations that they need to set aside money for or plan for. And then the investing piece comes afterwards. So it's helpful for us to understand fully as much as possible that person, what their objectives are, sort of roughly map out how we can support that person along with what the investing piece looks like when we have everything else kind of before that point sorted out and solved. So really just a really fantastic getting to know you type conversation.
It is kind of like a first date in some ways, right?
Yeah,
Like I think a
totally.
lot of it is a bit of a vibe check. Is this someone you want to work with? How good of a listener are they? The advice I've often given people is like almost like do a bit of a mental alarm clock. How much are they talking versus how much are you talking?
Yeah.
If you get someone like Darryl, I know you're the type of person that's going to ask a lot of questions and get them talking and doing that. But a lot of advisors do kind of approach it more like a sales pitch. And so if they're the ones doing a lot of talking and trying to like convince you, that can be a little bit of a yellow flag or even like an orange flag. What are some other little like yellow flags or red flags that people should consider? Like,
Someone who's talking over you and not really listening to what you're saying, just is sort of stuck in that sort of like got to sell you sort of mentality. Someone, anyone who just doesn't have the curiosity to, sort of learn about you as a person, because I think that's the key to getting a successful investing relationship. I think that's the biggest one by far. Biggest kind of
yeah,
yellow or red flag. And then, of course, and we see it less and less nowadays, but promise of outsized returns with minimal or no risk. Like,
totally. That's a huge red flag.
yeah,
So when it comes to expected returns, because this is something where if someone is selling you just on their like ability to beat the market and outperform, like I've heard in the past that anything that's like sort of like double digit numbers, like if they are kind of promising you like 10% annual returns, like that's always kind of a flag for me. What are the expected returns that you usually try to like set people's expectations at?
I don't usually lead with that argument, to be honest with you, because it varies depending on the specific person. That answer is going to be different from the person who's in retirement versus the person who's 20 and just getting started saving for their retirement journey. So things to consider, especially now as people are looking to potentially switch. 2024 was a fantastic year for all the markets, equity, fixed income. So it is true that there have been 20, 25% plus returns in the overall
Yeah.
market for balanced portfolios. Like it was an incredible year. That was 2024. Is the expectation that that's going to be that going forward for forever and forever? Don't think so. So, I think at this point in time, be, aware that that was the experience in 2024. When we look at what we expect investment returns to be, and if we're looking historically over multiple decades, diversified portfolios generally have returns when you look at across many, many decades in the high single digit range. Like that is just a historical fact for balanced portfolios. The equity market's a little bit more than that. But when most portfolios that we're running are going to include equity, so ownership in companies, along with fixed income. So high
Yeah.
single digits is, sort of like what we're kind of roughly expecting. When we're doing plans for people, it's actually a little bit lower than that because we want to sort of be conservative and we want to, as much as possible, make the most amount of money. We do want to have some diversification and have some stability to portfolios. So all of that to say, it depends on the person and depends on what their objectives are. But on myself as a portfolio manager, I'm never leading an argument saying that this is the why behind our relationship to generate excess returns with minimal risk. It's really part of the discussion with clients, but not the main one for sure.
But I think that's it. I think that any conversation that's focused on returns is already a bit of a flag. That if they're trying to sell you based on past returns, or if they're trying to sell you based on, oh, we'll be able to beat your, the returns, that's really, that's a bit of a flag. Most returns across the board are going to be very, very similar, right? And if people are promising in higher returns, then, well, it means they're going to be giving you higher risk. So, we really want to be aware of that. And that really what you're looking for an advisor is someone that you do vibe with, someone that's going to look after you, someone that's really going to provide that high level of service rather than someone that's going to promise you high returns. Is that fair?
Fair, absolutely.
Okay, sweet. So from there, once you've decided where you've landed, and this is where you might need to have a couple conversations, you might need to, by all means, shop around a little bit. But once you've decided where you're going to go, who you're going to go with. That's when we're going to open up all of your new accounts. This can be a little bit of a paperwork intensive process. Darryl, I see you smiling. I know you've been through this quite a bit. Can you help people understand what they should expect when it comes to opening up the new accounts?
A lot of information gathering for one, and not too much, but sometimes it's just not information that people have at their fingertips. Like they might not know or recall the SIN number of a beneficiary, which is required information to open up a registered account. So it can sometimes take a little bit of homework and gathering for people, and that can take a little bit of time. But really, once we gather that information, we take care of actually putting together the paperwork in the format that's required, which is a skill in and of itself, and then sending that over to our compliance team to get everything up and running.
Perfect. So it should be, especially with full service advisor, like you're the one that's kind of like figuring out what accounts they should be opening, kind of doing all of that detailed work, getting all the paperwork set up. And then, but people are going to have to provide information. You're going to have to provide these. You mentioned a SIN number, like your social insurance number. If you do an RESP, we're going to need the kids' SIN number, and so we are going to need some of that information. But then it should be a pretty straightforward process once we've got all of that data to be able to open up the accounts, and that's something that you can really handle for clients. Is that right?
That's right.
Amazing. Perfect. So from there, this is the piece where I think people get really kind of hung up on this, where they think they're going to have to sort of break up with their advisor, and kind of have a really tricky call where they request the transfer. But that's actually not the case. That when we initiate transfers, that once the accounts are open and we're ready to move everything over, that it's your new institution, it's your new advisor that will initiate those transfers for you. Is that right, Darryl?
That's right.
So talk me through kind of how that works. If a client's going to be moving their money from RBC over to Genus, how does that look like? What does that look like?
We collect the information for that client so that when we send it over to the sending financial institution, they can properly identify that person, their account number, the type of account it is. That all needs to be completed with 100% accuracy, or it gets sent back, it gets rejected. So assuming we've got all of that information and that it is accurate, that information is sent to the sending institution, and it's not a request, it is a demand. They have to, once the clients have signed off on that transfer paperwork, the sending institution has a certain time period and the clock ticks right away. They've got to send those funds over to us.
Okay, perfect. So you're the one doing it. You're going to probably get people's statements. So if they're moving from RBC, you'll get their RBC statements. You'll get all of their account numbers. I notice is we have to be careful about doing, for example, RSP to RSP and TFSA to TFSA, making sure all those numbers line up, making sure that someone's name and birthday line up with what's on their ID, so that there are some sort of verification things that happen from there. But it's really, you're the one that's going to be initiating that and sending all the information to request that transfer.
That's right.
Okay, perfect. From there, I'm a big fan of this, is that once those forms have been filled out, that's when we kind of send a courtesy email to our existing advisor. If you want, you don't have to do this. You don't have to send that breakup email, but I do think it's a good idea to thank someone for their service. Let them know this is a really good time to tell them why you're switching, especially if it has to do with sustainability and the lack of sustainability products and just kind of finding the right fit. That you don't need to justify and tell them why you're doing it, but I do think it is nice to send a little courtesy email to give them the heads up that they should be expecting those transfer forms. Darryl, I know you've written these for clients and kind of provided any sort of advice or feedback you've got when it comes to sending this courtesy email.
You don't have to do it. It's a very nice thing to do. I think, especially if you've had a long-standing relationship with that person. I think it's a nice thing to do. It's the kind thing to do. For people who need sort of scripts or tips, please let me know. And we've got that. It's a business relationship, and it's not necessarily meant to continue forever. And so, I think this is the breakup email is a fantastic time to recognize that, and then be excited about the new chapter that both people might be embarking on.
Absolutely. I think this can be a barrier for a lot of folks is worried about, pushback or blowback. But at this point, especially with the transfer forms completed, it's a bit of a fait accompli. It's what's done is done. This is part of business. They're used to this. A lot of people are moving their money for ethical reasons. A lot of people are switching advisors. So it is a really common practice. So don't feel bad about it. I know it can feel a little funny, especially if there's a relationship there. But, I've never had anyone, sort of reply and with a tirade and, oh, you're making a foolish mistake. Like, no, no, no. Everyone is very polite and just says, thank you so much. And, really does keep it sort of, courteous. Sweet. From there, we do need to wait. You told me about 5 to 15 business days, sort of a week to a few weeks. I've had some instances where it is a little bit longer, where sometimes I feel like what we call the old institution will kind of drag their feet a little bit, but typically it is a fairly straightforward process. Is that right?
It is. I would say the bigger challenge we're having is with the online brokerage accounts and the discount brokerage accounts, which Tim and I still, I think, love, the online brokerage world, but they don't have the same service and support staff. So we're finding those
Yep.
transfers take a little bit longer. Otherwise, depending on the account, they can start making their way over in a handful of business days.
Amazing. So this is where it is a little bit scary, because there there is this notion of sort of your money is in transit, right? So oftentimes it's a little bit scary because it's sort of left the other institution, hasn't quite arrived at the new institution. But like, don't worry, everything is safe, everything is secure. But it does take in the manner of like a couple of weeks for that transfer to take place. So from there, we get to celebrate. Woo! That's it. Those are the steps. It really is pretty straightforward. I know it feels overwhelming, but I'm just going to go through the steps like super quick so we can see them. But it's like decide where you land. This is probably like the trickiest bit, I think, requires sort of the most kind of emotional labor upfront is actually finding an advisor that you do trust, that does align with your values, that is going to look after you. From there, it's pretty straightforward. You're going to open up all your new accounts, do the paperwork, fill out the forms, get that going. They should really help you with this. From there, you're going to initiate transfers with your new institution. So they're the ones that's actually going to break up with the old institution for you. You're going to send a courtesy email if you want. You don't have to do this, but this is just like that little nicety. And then from there, we just really wait for the money to arrive, that it does take a little bit of time for that to go through before we can celebrate. Darryl, did I miss anything, or is this pretty good in terms of that kind of step by step?
Oh, the one thing you missed or that we've talked about is pictures of identification,
Oh,
which we
well, we've got that in the hot tips.
okay.
So we're going to talk about that in a minute because we do have some hot tips for everyone. I see Alice's question here. It seems that there's a narrative around do good investments, saying that they are risky, that they don't perform as well, et cetera. Do I have to accept that if I want my investments to adhere to my values? So Alice, let me just address that right away because I think this is a big question, and this is a big part about sort of like deciding where you land, because I think this is a big thing. When I look at different institutions, that basically every organization is going to have sort of doing less evil options, but it's pretty rare. I think it's something that like sticks out a little bit in terms of firms and advisors that do have doing more good options. Typically, when it comes to doing more good, I do split it up between the sort of the impact investments, which are the crunchy granola things, and then the more what are called thematic funds. Thematic funds are a little bit more common. That's where the returns are. It depends. They do deviate. Like Darryl, I know that Genus has a sort of an impact, sort of like doing more good global equity fund. I don't know in terms of the returns for that. My guess is that that would be kind of like similar. compared to a traditional global equity strategy. But in my experience, it does deviate a little bit. Like in 2020, coming out of COVID, the doing more good stuff, especially green stuff, really popped. It really sort of like outperformed. But since then, it has lagged a little bit. It hasn't been terrible. Some green stuff, like renewable energy and some of the sexier green stuff, really has lagged. But generally speaking, a lot of these sort of doing more good thematic funds have done reasonably well over a long period of time. Is that safe for me to say?
That's safe for you to say. So I don't have the exact number as of the end of the year, but the high impact equity fund at Genus, the return was, last I checked, at the very low side of the double-digit range. That's over the course of about 9 years. So yeah,
Yeah.
quite excellent and
So
very
it
much.
has earned market rates of return.
That's right.
But Alice, I do want to say that when it comes to the do good investments, like the impact side, the real like crunchy granola impact first stuff, that's where we kind of are sacrificing returns a little bit, in the sense that like if I'm loaning money to a nonprofit or a co-op, like I'm not trying to make bank on that, that I am comfortable earning a slightly lower return or taking on a little bit more risk when it comes to those impact first investments. So this is why, like with my framework, and I've got some other videos and things that I can point you to that kind of explains the approach that I take, but that, if we think of your pie chart, most of your money should be invested in doing less evil options that do earn those market rates of return. From there, we can carve out part of it for these like thematic funds, like Darryl mentioned, the sort of high impact option that they've got. But then, when it comes to the impact investment, this is where I do want it to be a smaller slice. I still want you to do it. And that was kind of my point at the start with the tariffs. Like, I really want people to do it to invest locally, but I don't want you to go all in on that. Because that is the place where it is just like it's different. So on the one hand, it adds to diversification. It does help us, especially if there's like a global crash in the stock market, in the bond market. Hey, those impact investments are just going to keep ticking along, very, boringly, like in a way that, they should be fine and should do well in that kind of environment. That said, they are different. They are unique. That is the piece that we do want to understand, that we might be taking a little bit more risk there. Darryl, I know you guys do offer like an impact investment council. My understanding is that it's only for some of like the higher net worth investors at Genus, but can you speak to that at all?
So yeah, the Impact Investment Council is an amazing service we offer. It originally started with working, with the needs of larger foundations. So the David Suzuki Foundation is a great example of a client of ours, and some of the investments are, invested in a certain manner, but there was desire to go a little bit deeper when it came to the definition of impact and how we can allocate money towards specific causes, whether it be affordable housing, whether it be for something like the Raven Indigenous Outcomes Fund. Like there are a lot of different investment options out there. Unfortunately, the accredited investor status means that it's only available to people above a certain threshold, and that threshold is about $1 million in financial assets. So it's fairly significant. But it is something that some of our clients definitely do qualify for, and they're interested in having an impact with their money that goes beyond what's available in the publicly traded stock and bond market.
And I think my understanding is that, when you are at that level where it's the term accredited investor really is a level, a measure of assets and wealth. And so that, and that a lot of those options, I assume they are at that point kind of like, or trying to generate a competitive sort of risk adjusted return. I think it's more, when we do talk about making the sacrifice, it is a lot more of the more sort of crunchy granola things, the things like community bonds or microfinance or something like Fair Finance Fund, where we're doing loans to entrepreneurs in the food sector, those ones that are available to, us regular folks who don't have $1 million, where, maybe they've got a minimum investment of $500 or $5,000 that are a lot more accessible. Those are the ones that I think do tend to be, where we are sacrificing returns, where we are either earning a lower return or taking more risk. And so again, but like as part of an entire portfolio, if that's like 5% of your entire portfolio should still earn those competitive risk adjusted returns. So Alice, I don't want you to assume that you have to sacrifice financial returns to like do good, but there are some of those little, it depends questions when we get into this world of doing more good. Okay, great. Kyle is asking, does Genus Darryl do fee-only consults for DIY investors? No, Kyle, that is where you're going to want to work with me. I am the person that does the DIY investors, and I can serve clients from Quebec. So let me get through the sort of the rest of the presentation here, and then I can get into exactly kind of how, if you do want to work with Darryl, if you do want to work with me, how that would work. But let's get through some of these hot tips. Okay, take a clear photo of your ID and have your SIN handy, your social insurance number handy. Darryl, can you please tell how frustrating it is that people have to like have a very clear photo of their driver's license or passport?
Okay, it's kind of frustrating, but also I think we should feel, I think, a little bit of just sort of gratitude in the world where people are meeting less often face to face, right? Like, yes, the requirements to properly identify people are becoming tighter and tighter and more stringent. If we could get away with kind of a blurry photo, maybe say a couple of years ago, and it maybe was a little bit sort of, sort of crooked, if that was acceptable, it definitely is not acceptable anymore. Things need to be crystal clear. They need to look like they're a real picture. So it's okay to have, a wooden table kind of, in the background around the border of it. That's great. That's a way for us to understand that this is a real photo that somebody's taken. So no glare, centered, um, a little bit of a border around the world that's going on around it. Those are key things that help us get reassurance that you are indeed who you say you are, and that you actually do have that document and it hasn't been doctored. So it's becoming a little bit more challenging. Sometimes we have to do a retake for a driver's license or a passport, but know that that is part of the getting started process.
Okay, this is a really important one, in cash transfers versus in kind transfers. So this is always like a big consideration when it does come to taxes, and, sort of understanding that when we do those transfer forms, there are two different types of transfers we can do. Darryl, can you please explain to the good folks the difference between an in cash transfer versus an in kind transfer?
In kind means that your investments would stay pretty much intact as they are with your existing institution. There would be no changes to either the cost basis or what they're actually invested in. They would just move their way over to Genus. Now, there are restrictions and there can be complications when that is happening. The biggest complication we could run into is a situation where a financial institution has an investment product that they only have, and it's called proprietary and not available outside of their universe. And that's the case, that kind of asset cannot move over in kind. In fact, in reality, the majority of the assets that do move over to Genus are in cash. And what that means is that the assets are liquidated at source, so where they are inside those accounts, even if they're in an RSP or even if they're in the TFSA, that money does not leave the account. It simply gets converted to cash. And then that cash makes its way over to Genus, and then it's placed into the corresponding account there. So in kind, very few of the accounts that we sign up are moved over in what's called in kind. We'll do it for accounts when we want to be really tactical around, say, something like tax exposure and managing that over a few years or a year. The majority of the transfers are in cash.
Perfect. So in cash means we're going to sell everything you own, we're going to move over the cash, and then we're going to buy whatever the new investments you want to own. Whereas in kind transfer means we're going to move it over as is, which leaves it as is, so that once it arrives, then it can be sold, either in chunks or all at once, depending on the situation, but it does stay kind of invested throughout the transfer. And that, yeah, I've had all kinds of headaches with in-kind transfers, especially when it comes to mutual funds, especially when it comes to these, you mentioned these proprietary funds. So if it's not something, the easiest thing to do in kind are going to be like individual stocks or ETFs, like existing things. Those tend to be a little bit easier. Whereas, anything that has the name of the firm kind of like in it, there's a good chance we're going to have to do that in cash. Either way is fine. It doesn't really matter. Obviously, the goal is to get your money moved over anyway. At some point, we're going to be selling and repurchasing the stuff that you actually want to buy. But this is language that I think really oftentimes people do get caught up in. From there, the other hot tip is, regarding taxes, want to be clear to folks that there are zero taxes when it comes to registered accounts. So when it comes to things like RSPs, TFSAs, even like our ESPs, if there is sort of like an acronym attached to the account, you don't have to worry about taxes at all, zero taxes at all. Whereas it's only when we have what's called an unregistered or a taxable account that's when we do have to be worried about taxes in the transfer. So Darryl, can you talk a little bit kind of about how you sort of like approach this? When it comes to like registered accounts are easy. My understanding is like zero taxes, those are free and clear. But when it does come to if people have an unregistered account or what we call a taxable account, how do you sort of approach that?
There's an extra level of assessment that happens for taxable accounts. So we want to have an understanding of, if the investments were to move over in cash, what type of tax liability might that create? Might there be a significant amount of capital gains, or might there be negligible capital gains, or maybe even a loss, depending on what their investing experience was. So we're charting out what the prospective tax liability might be in those types of accounts, and then making an informed decision. For some people, it still makes sense to move their money and just accept that they're going to have to pay some capital gains, and then they're done with it. They move their funds over, they have a bit of a tax bill to pay the next time they file, and then they carry on with a portfolio that's better aligned with their values. For other people who might have a more significant portfolio, or a portfolio that has had significant gains, it might make sense to do a couple of things. There is the possibility of moving things over in kind. There may be possible to move things over in a staggered fashion, so you're not taking all of the capital gains in a single year. So you may opt to take part this year and then part in a later year. So in many of those cases, in all the cases, it really starts with an assessment. Just getting information and then being able to make an informed decision. We're not looking at taxes as a hard barrier that we would say never pay, and that's never the perspective, I think, of a lot of clients. It's really just about transparency and understanding what money they may have to pay if that happens.
Yeah, totally. I think that there have been a lot of talk about capital gains taxes, over the last year here in Canada, because there were some changes. And if people aren't aware of what that means, it means you're only taxed on your profits when it comes to investments. And so if you bought low and now you're selling high, whatever your gain was, that gain counts towards your income. We usually cut it in half. So half of your profit, half of your capital gains gets added to your income, and that you will have to pay taxes on that. So I think the big point here and the hot tip here is that, a good advisor, if you are making the switch, is going to do the assessment for you ahead of time. That if it is a really simple, straightforward switch, if it's only registered accounts, you don't have to worry about it. But if there are unregistered accounts, then, a good advisor is going to be looking at that, is going to be doing some math for you, is going to be explaining to you what the expected tax bill is going to be. And if it's going to be a really high number, it's probably going to come to you with some strategies where we can, minimize that or spread it out over time. Is that fair?
That's fair to say, for sure.
Okay, perfect. I do see a couple questions. Alice asks, will there be fees related to in-cash transfer, fees for selling / cashing out, and then buying / investing new? Not really. Typically, these are really minimal. There might be like, sometimes with online brokers, they might ding you with like a $5 commission or something, $10 commission for selling, per security if you do it in cash. Honestly, like really a lot of those things are super, super minimal. I know some institutions do charge what's called a transfer out fee, where it's like they'll ding you for like $50 or $100 per account that you're moving over. Darryl, can you think of any other, like, usually these fees are really, really minimal, will be like it's kind of them sort of like nickel and diming you on your way out. But I don't think, people should expect any like major fees when it comes to switching. Is that fair?
No, that's definitely not the situation. Where there can sometimes be fees are for people who have investments, unfortunately, in products that have what are called deferred sales charges. So we haven't
Oh, right.
about them this time. We talked about them last time, but deferred sales charges effectively act as a bit of a penalty if you are to sell your investments before a certain maturity date. Each investment in each mutual fund may have one in your portfolio, especially with a few specific institutions that have them around, that might be the only thing to be aware of. And that's a phenomenon that
Yep.
can exist in registered accounts or non-registered accounts. Deferred sales charges. If you see
Yep.
DSC somewhere on your
Yeah.
statement, it means that that particular investment product is subject to a deferred sales charge. Not a barrier, not a do not go. It's just another piece of information to get to help us make an informed decision.
Yeah, these deferred sales charges, they've actually been outlawed, that they're not allowed anymore, but some of the older funds still have them. And it's really annoying. They disappear after 7 years, but if you sell them before 7 years, they kind of like slowly go down. So we don't see them as often anymore, thank goodness, but they are still around. So again, this is why, you'd want to work with your new advisor, to do that assessment to make sure if there are any of these like sneaky little fees or anything like that, that we have full transparency over that. Oftentimes, as Darryl said, we kind of just rip the Band-Aid off, but I think it's nice for you to be able to have that information before you're making that decision. Liz asks, do you recommend accountants to help make decisions such as real estate and other investments? So yeah, I mean, I'll speak for myself that I really love. I think people should have a team. So understanding that you want an advisor, that you want an accountant. Sometimes people also need a lawyer, especially if we're dealing with corporations and things like that. But generally speaking, financial advisors that we can provide general guidance around taxes and tax optimization and things like that. But because it really often does require, a really, really high level of knowledge about your intimate financial details, that I think oftentimes we do work with an accountant. Darryl, is that fair? And I think you've got like accountants that you recommend if someone joins you and they need an accountant. That's probably an introduction that you can make. Is that right?
Yeah, as always, the answer is it depends. For more complex situations, for people who have a corporation, or if
Yeah.
they're like an operating company or holding company, cross-border, definitely accountants are a huge help in terms of just providing somewhat of a framework when
Yeah.
working with individual clients. For regular employee people who are employed and they're saving their RSP and TFSA, accountants I think have less sort of like offer input. There's less wiggle room and flexibility, but certain for the more complex clients that we have, accountants are really instrumental, I think, in just framing what makes sense. And then from that frame they provide, we can then, as advisors and portfolio managers, kind of put together the portfolio that makes sense for them, both from a
Yeah.
value standpoint, from a risk reward standpoint, and from an efficient taxation standpoint.
Totally. Sweet. Last one is just like be a squeaky wheel, that if the money's in progress or if things are happening, like sometimes it does require a little bit of like persistence on this. But again, I think this is where having a good advisor is really helpful. Like Darryl, am I safe in assuming that oftentimes you are that squeaky wheel on behalf of your clients?
Yep. Yep. Absolutely. It's really cool.
Yeah. This is something with DIY investors. I'm always like, you kind of have to advocate for yourself, but this is definitely one of the benefits of going full service, is that you'll have someone like Darryl who's really going to kind of steward that process for you. If something gets rejected, you'll find out right away. You'll have to retake the photo or do whatever it takes. If the account numbers don't line up or the name doesn't accurately match what's on your ID, these are all things where it could get kind of caught. You could get stuck. And so, being on top of it and being aware, or having someone who's on top of it for you, is really, really useful. Does this help? Like, how are we at, chat? Like, how are you doing? I want to make sure that, hopefully this gives you a really good idea of what it takes to switch advisors, as well as some things to consider. Would love to just, know sort of, how you're doing in terms of your experience. I know this can be a little bit of an intense topic, but hopefully you're sticking with me, because we do have a little bit of a gift for you. Liz does ask here, so the advisor and accountant speak together and then speak to me, or a joint meeting? I'm concerned about being bounced around and not understanding fully. Okay, this is, let's kind of like come back to here, in terms of the tax thing. Darryl, like, are you, is it, how do you work with an accountant? Like, how does that work?
Usually the involvement of the accountant is after they have become an actual client. I would say it's less the case that we're working with clients, accountants beforehand. Afterwards, it's just a check-in to understand over the course of a year, sort of are there any thresholds for them to be aware of in terms of income that's coming from other sources? Are there capital losses from previous years that we might be able to use when it comes to minimizing someone's capital gains liability in a specific year? So it's really more so afterwards. The bouncing around I can understand, in terms of different messaging. For most people, I would say the accountant is going to be less helpful. They are fantastic for regular people kind of filing taxes if you don't have a corporation, operating company, holding company, or cross border. I think accountants have a fairly limited sort of usefulness when it comes to the investing side of things. So I would really stick with, if you're unsure of who to trust, what to listen to, Tim and I think are a little bit biased. Fantastic places to start, and then just can help guide you in a concise direction that'll prevent any type of, I'm sure, really well-meaning advice that might come from this person, then might come from this person, and then might come from this family member, might come from this. Like, there are just so many different ways, and you can absolutely feel like you're getting bounced around when it comes to figuring out where you want to land and what you want to do.
Yeah, typically, Liz, like the approach that I take is that I kind of will give you the guidance that I think is right. I will get you to go to your accountant to like give you a thumbs up on it. If they give you a thumbs up on it, then you're good to go. Then we can just kind of implement that right away. If not, then, then it might make sense. I've definitely sat in on a call with someone and their accountant just to like get on the same page to make sure that everyone's sort of in agreement there. But I would say joint meetings are rare. That typically what we're going to do is meet with you, tell you like, here's what we think. But like meet with your accountant just to like confirm some of these assumptions. And then from there, 95% of the time, we arrive at the right decision. All right, sweet. Alice says lots of good information. I have more questions now than I did when we started, but that's not a bad thing. Thank you both. Marlene and Lori are both in Quebec holding out. Darryl, we are going to run this up the flagpole that we have people interested in Quebec, that let's get Genus on that. And then just know that I am kind of working on some other solutions on the side, but that, fingers crossed, we will get a solution for our lovely Quebecois attendees soon. Do have a little gift. So, for every live attendee, I saw the number. I think the number I saw was 31 or 32. So for everyone who's live, we're going to donate $10 to a nonprofit or a charity. So just for coming and showing up and being here and sticking around, we're going to donate $10. I've got the organization that I love. I kind of looked at it. I chose one called Growing Chefs. So Growing Chefs Ontario is all about teaching kids how to grow food and cook food. So that is kind of my organization that I want to support. I'll throw them in the chat just if people want to check out Growing Chefs. But I just think, having kids growing food and cooking food is just so important. Darryl, I don't know if you've got an organization that you want to support.
Yeah, mine's in the same ballpark. I wish we had slightly different ones here. So I'm gonna go with Not Far from the Tree. I'm sure
we love Not Far from the Tree.
Yeah, I'm sure people in Toronto know of the organization, but they do amazing work. And yeah, I think in terms of just cultivating and understanding about growing in an urban environment, right? And what that looks like, and mobilizing resources to educate people, to inspire people. I think they're really fantastic.
They're super cool org. Not Far from the Tree is a great org. But chat, what do you want? Throw your favorite nonprofits in the chat. We usually kind of go through the chat afterwards, and we'll pick a couple of your recommendations as well, and we'll just kind of split that up. From there, if you're watching on YouTube, listening on the podcast, for every sort of like, comment, subscribe, we'll throw in an extra $1. So if we get a whole bunch of likes, that number could go up. But we'll donate at least $320, and we'll see how it goes. David Suzuki Foundation, Code, Toronto Indigenous Harm Reduction, big fan of them. Alice, absolutely, we can make sure that they get on the list. I know that organization, they do some awesome work. Perfect. Join Spice. Pam says, thank you. I'm in the midst of moving over from Raymond James to Genus. Darryl and his team have been great and careful completing the paperwork, and I can't wait for it to be complete. Amazing, Pam. This is awesome. Fantastic. If there are any other nonprofits, if there's anyone else that is in the midst of switching, that would be great. From there, it's just really the question is like, who's ready to switch? Who's ready to actually do this? Let me just share the link with here. I'll just show you the page with Darryl if you want to sign up for a meeting with Darryl. Genus has been doing this since 1994. Full service management, divest from fossil fuels. They do some impact investing. Here we go. Alice is at Raymond James, just thinking to start to switch. Alice, you go to this link here. Let me throw it in the chat again. There we go. Go to this link, set up a meeting with Darryl. It's very simple. You just, Tim Nash, or I'm supposed to do my last name there, Nash, Tim at goodinvesting.com. Book a meeting with Darryl. Here we go. And it redirects to a calendar. We can see when Darryl's got availability. So, he's got some time in March. Looks like you've got March break off, Darryl. So, completely understand that. But, lots of times available soon. So really want to encourage people to do that. If you do want to set up a meeting with me, you can go to my website, goodinvesting.com, and request a free consultation up here. I've got a little bit of a form that you can fill out here. I will say I'm a little bit slammed. I'm now booking meetings in April. But we do have a question where if it's urgent, we can always try to sneak you in. So just know that I'm absolutely here for you as well. If you are a little bit more on the DIY side, or if you do want to chat with me to see whether Darryl is the right fit, or you want to talk about him behind his back, I'm so here for it that we can have a little chat first. Sign up for a free consultation with me. We'll get back to you in a little bit, and we'll book a time in April. So really from there, just really want to reiterate the conclusion here that it's easy to switch. It's not that hard. We'll walk you through it. It's a bit of a process, but it's not that much. You only have to do it once. You only have to do it once. The best time to plant a tree was 30 years ago. The second best time to plant a tree is today. So really want to encourage you to make that switch today, and just know that we absolutely are here to help. Reach out, however much money you've got, whatever your situation is, know that we've got some really cool resources, and always happy to help people out. So I can see a question in the chat, and we can absolutely spend some time in the Q&A. Okay, so Wei Ming here is saying, sorry, I have a question. Don't apologize, please. We love questions. A financial planner told me the management fees will be paid by the product provider, commission-based advice to them. They stress that they provide independent advice, and they get paid the same percentage across the board from different providers in same categories of products. Does that make sense, or is that claim a red flag? Another plan they offered is to people on annual fees based on percentage of assets, but that's for people with over 500K. Oh my goodness. Okay, so this is an amazing question. Okay, so in terms of this question about the fees, okay. So first of all, this notion that management fees will be paid by the product provider, this to me is definitely a little bit of a flag, just in the sense that this screams to me, I think what's happening here, Darryl, is this is what we would call a trailer fee. So Wei Ming, I'm guessing that this is an advisor that is likely trying to sell you a mutual fund, and that embedded in the mutual fund is going to be not only that product fee that Darryl mentioned before, but also the sort of planner fee, and that it would be embedded, and that that it would be sort of presented as a bit of an all-in-one management expense ratio, MER. Darryl, do you think I'm right here that this could be like a trailer fee scenario?
I think so. And in the end, you kind of, the way it works as the client, you overpay in this wrapped up fee that goes to the advisor, but by way of the product provider. So they're not lying, but in the end, it's you paying for it anyways. So
Yeah.
yeah, it's
Yeah.
there's no freebie in there in that model. It's just sort of like a semantics in terms of how they're outlaying the fee structure to you.
And they could be independent. Like this is going to be a big, like, it depends questions. But, generally speaking, what I'll say is that I know how these product wholesalers work. And, they might not be like paying them directly, but they might be like taking them golfing or giving them tickets to the Maple Leafs or, sending, sometimes it's like people that sell the most of a product get like a free trip to the Caribbean, for them and their wife or something like that. So, it just is a little bit tricky. I would want some transparency around that. And that really it's going to be, what is that combined fee? That if they're saying, that what is this management fee? And that again, if it's anywhere like sniffing 2% or north of 2%, then, which often I would expect from an advisor in this way, if they are more of a salesperson, but to me, it is going to be, I would want a little bit more transparency there. Another plan they offered is to put people on annual fees based on percentage of assets. So this is typically how it works. This is how most advisors do it. But that's for people with over 500K. So, again, it's just like these things are a little bit tricky. We would need a little bit more information there. But, that this could be a situation where, they are splitting up that product fee and that planning fee. Maybe, it's hard to have full information there. Liz says a step that I need to make first. How about a financial counselor recommendation? I have issues around trust and reliability based on familial experiences. Ooh, Liz. Okay. So I have a couple thoughts for this, Darryl. I don't know if there's anything that you're thinking of off the bat.
Yes, but I think more appropriate for like a direct conversation. There are names, I'm sure you and I both have the same sort of like subset of names, and who
Yeah.
is kind of like the best fit will really depend, I think, on more, sort of deeper understanding of your particular situation. But there are people
Yeah.
who absolutely specialize in the area of financial counseling, financial therapy. If
Yeah.
you haven't heard about that sort of intersection, it's super cool. Yeah, super cool.
So I'm gonna all say the names. I don't
And
mind doing it. So, like, first thing that I suggest is there is actually a course called Trauma of Money that I haven't done this, but I know some people that have TAM. It's pretty awesome. This is a really, really cool program. I'll just throw it in the chat. But this is very, does get into a lot of the sort of like deep stuff around trust and overcoming, personal trauma. Their alumni directory is like a little bit of a who's who list. Like they've got some really amazing people in this community. This is cross border, so I think some of them are Canadian, some of them are American, but I know some really, really cool people there. And then Natasha Knox is I assume who you were probably thinking of, Darryl, that Natasha Knox, Alafia Financial Wellness, is amazing. Now, she's not cheap, is like the only thing. I don't know if she's got a pricing. I don't know if she's got what she's got. I don't know if she'll put it on her website, but like I know she's not cheap. I would go through this process to see sort of what makes sense, but that, this can be really, really, really helpful. I've had her work with a couple of clients. Typically, it's like higher net worth folks who do have a lot of like guilt and sort of funny feelings around their money. But Natasha is top notch. I did do a podcast episode with her. Let me see if I can find it. So it was my old podcast, which was with the Toronto Star. So
and
that's Natasha, and she's amazing.
yeah, I would add in the view, pretty seriously that in certain situations, it could be really, really expensive to not
Yeah,
work with either a counselor, therapist, or a
fair,
financial therapist. In many
fair.
situations where people have lived experiences, they may have wealth or not, and trying to deal with that intersection takes a lot of, I think, language and conversation that a lot of people in the industry don't have. It's really neat that more and more of the industry is recognizing that this is a gap. And it's a meaningful gap that can prevent people from making informed choices or getting through a lot of the emotional or guilt or shame when it comes to getting around to doing things with your money.
Kyle did ask earlier about foreign withholding taxes. So, okay, so this is like my super nerdy reference that I will link for you. Kyle, I hope you're still in here, but this is foreign withholding taxes for equity ETFs. This is like the white paper that I love. So if you are still around, I'll just share that because I know that I would promise to do that. So I just want to make sure I do that before I forget. I'm going to say last call on any questions. Otherwise, Darryl, you've been so generous with your time. Thank you so much. Thank you so much to everyone who participated and attended, especially those of you who like stuck around for the whole time. I can't tell you how warm it makes my heart for you to be doing this. Super, super grateful. Really hope that you reach out to Darryl, set up a free consultation with him. Otherwise, reach out to me, set up a free consultation with me, join my classroom. Lots of information. Yumi, great to see you. Tammy, thank you so much for coming. Jason, really, really appreciate it. Classroom link. Yep. Okay. I hear you. We'll go. Classroom is here. There it is, Jason. Join the classroom. We're doing that. AMA Ask Me Anything next week, next Tuesday. And we'll be back with another webinar soon. Darryl, thank you so much. So grateful for your time. Any final words for the audience?
No final words, just reach out. I think Tim and I just like to talk money with people who share our perspective of trying to do good with it. So yeah, absolutely reach out. Even if you're not thinking about switching advisors, reach out. We'd love to chat.
Awesome. Thank you so much, everyone. Thank you, Darryl. Have a great night. Bye. Wow, that was a big one. I hope it wasn't too much information. A huge thanks to Darryl Brown, Portfolio Manager and Head of Eastern Canada at Genus Capital Management. He really knows his stuff. Thanks to my producer, Yamini Cohen, and thank you for listening, especially to the end. You're the best. See you soon.